Okay, so you want to buy an investment bank. Find some bankers, charge fees, watch the deals close. But here's the strange part. The most valuable thing inside Goldman Sachs, a firm worth over $100 billion, is not its buildings, its technology, or its balance sheet. It's roughly 400 senior bankers who could quit tomorrow, call their clients from the parking lot, and take the entire revenue stream with them. That is what you are buying. And figuring out how to own that asset is how some people made more money in a single day than most businesses generate in a lifetime. By the end of this video, you'll know exactly how that works. Let's start with what it actually costs to get in. There are 3 sizes of investment bank, and the economics are completely different at each level. At the small end, you have a boutique advisory firm. Think Centerview Partners. 5 to 10 senior bankers, no trading desk, no balance sheet risk. You advise companies on mergers and acquisitions, collect fees, and go home. Startup capital is under $10 million. Annual fees, if you recruit the right people, can reach $50 to $200 million. The margins are extraordinary. The catch is that you are entirely dependent on those 5 to 10 people. And if 2 of them leave, the firm is worth considerably less than it was yesterday morning. In the middle, you have firms like Evercore and Lazard, publicly traded or structured as a partnership. Market cap somewhere between $500 million and $2 billion, 1 to 2,000 employees. Advisory work plus some asset management. Lazard went public in 2005 at a $2.7 billion valuation after its managing directors resisted the idea for over 150 years. Evercore's founder, Ralph Schlosstein, took home $34.3 million in 2022 compensation alone. The mid-market is where the partnership model survives longest. At the top, you have Goldman Sachs and Morgan Stanley. Over $100 billion in market cap, 40,000 plus employees, advisory plus trading, plus asset management plus lending. In 2023, Goldman reported $46.3 billion in net revenues. The entry price for the top tier was set on May 3, 1999, when Goldman Sachs listed on the New York Stock Exchange at $53 per share, valuing the firm at $33 billion. Now, 2 costs nobody warns you about. The first is human capital flight. When you acquire an investment bank, you are not acquiring contracts. You are acquiring relationships. Senior bankers have no non-compete agreements that hold in court. When Drexel Burnham Lambert collapsed in 1990, the firm's assets were essentially worthless without the bankers. The bankers left. The assets stayed. Buyers learned an expensive lesson about what they had actually purchased. The second is cyclicality. Goldman's investment banking fees hit $14.9 billion in 2021. 1 year later, they were $7.7 billion, a 48% drop in 12 months. You cannot cut costs fast enough to protect margins when deal volume collapses, because your costs are the people who generate the revenue. Cutting them to save money destroys the thing you are trying to save. So how does it actually make money? 3 revenue streams, each one counterintuitive. Advisory fees are the cleanest. When 2 companies merge, the investment bank advising the deal charges 0.5% to 1% of the transaction value. On a $10 billion acquisition, that is $50 to $100 million. For a team of 10 to 20 bankers working 4 to 6 months. Goldman's total M&A advisory fees in 2021 reached $14.9 billion. The work is producing analysis, running models, and making introductions that only work because the banker has a relationship the client doesn't. Underwriting fees come second. When a company goes public or issues bonds, the bank runs the process and charges 3.5% to 7% of the total raise. Goldman helped underwrite the Google IPO in 2004. Google raised $1.67 billion. Goldman's cut was approximately $45 million for a few weeks of work coordinating investor meetings and pricing the shares. trading revenue is the third stream and the most dangerous. Goldman acts as a market maker, buying and selling securities for clients and pocketing the spread on every transaction. In good years, trading is Goldman's largest revenue line. In 2009, 1 year after the financial crisis, Goldman posted record profits of $13.4 billion while competitors were still restructuring. Most of that came from trading. In bad years, the same desk generates catastrophic losses. Here's the part that breaks: people's brains. Goldman does not primarily make money from having capital. It makes money from being the intermediary between everyone else's capital. The firm's entire value proposition is access and credibility, neither of which appears on a balance sheet. Now, how do you keep the people who generate all of that? The partnership model was the original answer. Before 1999, Goldman partners could not sell their equity. It was illiquid, tied to the firm, and grew only if the firm grew. This created 130 years of loyalty that no salary could replicate. You stayed because leaving meant forfeiting the one asset that would make you genuinely wealthy. After the IPO, Goldman replaced the partnership lock-in with deferred compensation. Bonuses paid in restricted stock that vests over 3 to 5 years. Leave before vesting, forfeit the stock. In 2006, Goldman paid $16.5 billion in total compensation to roughly 26,000 employees. Average per person, $622,000. CEO Lloyd Blankfein received $53.4 million. The firm's best people were always 3 to 5 years away from a payout they could not afford to walk away from. The structure changed, the logic didn't. Which brings us to May 3, 1999. Goldman Sachs had operated as a private partnership for 130 years. The 221 partners who ran the firm had spent careers building client relationships, accumulating equity stakes they could not sell, watching the firm's value grow on paper, but never in their bank accounts. The IPO changed that. At $53 per share, the firm was valued at $33 billion. By early 2000, at the peak of the dot-com boom, that valuation had nearly doubled. Senior partner John Winkelried's stake was worth over $200 million. Hank Paulson, who would become U.S. Treasury Secretary in 2006, held equity worth approximately $500 million at peak. The IPO did not create that wealth. It made it visible and liquid for the first time. 221 people became extraordinarily wealthy in a single trading session. The asset had been walking out the door every evening for 130 years. In 1999, it finally took $33 billion with it on the way out. Not every investment bank makes it to that moment. Bear Stearns had been public since 1985. In early 2008, it had $395 billion in assets and $11.8 billion in equity. It also carried $33 in debt for every $1 of equity. That leverage worked perfectly when asset prices rose. On March 14, 2008, Bear Stearns told the Federal Reserve it would be insolvent by morning. The Fed brokered a sale to J.P. Morgan Chase at $10 per share. 12 months earlier, the stock had traded at $133. Shareholders lost 92% of their investment. The employees whose retirement savings sat in company stock lost nearly everything. The asset that walked out the door every evening had, in this case, taken the entire firm with it. Goldman and Morgan Stanley watched Bear Stearns go and converted themselves into bank holding companies the same year, giving up the pure investment bank model in exchange for access to Federal Reserve emergency lending. The era of the standalone investment bank effectively ended in September 2008. So, if you decide to buy an investment bank, here is the one thing nobody warns you about. The business you are buying is not on the balance sheet. It is in the contact list of 400 people who will be at a competitor's dinner next month if you get the compensation structure wrong. Goldman Sachs figured that out in 1869 and spent 130 years making sure those people could never afford to leave. In 1999, they finally let them cash out. The asset walked out the door. It just happened to take $33 billion with it. Tell me which firm or deal you want pulled apart next.